Welcome to another data-driven explainer. Today, we're putting a really unique financial tool under the microscope, designed specifically for securing equity exposure while keeping strict downside guardrails in place. We are analyzing the Aptus Laddered Buffer ETF, commonly known by its ticker, ABUF. If you're a risk-averse investor searching for a way to stay invested in the market while rigorously managing your downside risk, you're definitely going to want to pay close attention to the mechanics we unpack today. Here's exactly what we're going to cover. First, the volatility problem. Second, how buffer ETFs actually work. Third, the ABUF laddered advantage. Fourth, costs, efficiency, and friction. And finally, assessing the hidden risks.
Okay, let's dive into this. Can you stay in the market without losing sleep? It's literally the ultimate dilemma for risk-averse investors. You know you need the growth engine of the S&P 500 to outpace inflation and build long-term wealth, right? But the sheer terror of sudden, catastrophic market crashes can make holding unhedged equities incredibly stressful. It's that constant tug-of-war between capital appreciation and capital preservation.
Which brings us perfectly into Section 1, the volatility problem. The traditional way most people invest is through standard index funds, which are fantastic for growth, but they offer absolutely zero structural downside protection when severe economic shocks hit the system. Now, we're stripping away the marketing fluff today. Everything we're unpacking is grounded in hard, objective data from trusted platforms like FactSet and ETF Database. It is absolutely crucial to rely on the data, not just shiny sales materials, whenever you're dissecting complex financial engineering.
Let's contrast the traditional approach with some of the newer solutions out there. Standard unhedged index funds give you full market exposure, which is great, but if the market drops 20%, your portfolio drops 20%. To solve this, the industry introduced single-month buffer ETFs. These do offer downside protection, but they come with a massive catch: extreme timing and path dependency risks. If you buy a single-month fund in the middle of its annual cycle, say 3 months after it launched, and the market has already moved significantly, you are practically forced to perfectly time your entry. Get it wrong, and you might severely limit your upside, or even worse, lose your protective buffer entirely just when you need it most.
To really grasp why that timing risk exists, let's move to Section 2, how buffer ETFs work. We need to unpack the core mechanics of how these funds actually create their downside protection in the first place. So the crucial point is to think of a buffer ETF less like a typical stock and a lot more like an insurance policy with a deductible. The fund intentionally caps your maximum upside potential, meaning if the market rockets up 30%, you might only capture 15% of that. But in exchange for giving up that peak growth, it protects you against a specific percentage of market losses over a defined 12-month period.
Now, you don't need to be a derivatives expert here. Just know that the fund holds a complex portfolio of flex options. These contracts are the mechanical engine that physically builds that safety net and constructs that protective risk and reward floor for the fund.
But remember the timing problem we talked about with single-month buffer funds? Let's jump to Section 3, the ABUF laddered advantage, and see how this specific fund completely re-engineers the concept to solve that problem.
Before we look at the ladder itself, we have to highlight this incredibly important number, 15%. ABUF's underlying strategy is explicitly designed to protect investors against the first 15% of S&P 500 losses. It intentionally smooths out the ride, making it a highly compelling tool for risk-averse investors, retirees, or honestly, anyone whose primary objective right now is capital preservation during a market drawdown. And this brilliantly illustrates exactly how they do it. Instead of tying your fate to a single month, ABUF is an actively managed fund of funds. It takes your capital and divides it evenly across 4 quarterly tranches: January, April, July, and October buffer funds. By layering these expiration dates, ABUF completely neutralizes the severe timing risk we discussed earlier. It allows retail investors to deploy their capital at virtually any point in the year without having to constantly recalculate the effective hedge of a single expiration date. Ultimately, it's all about intentionally altering your risk profile, and this is the central trade-off. Your traditional unhedged S&P 500 gives you maximum upside but zero downside protection. ABUF trades away that maximum capital appreciation for a strictly defined risk floor. You are literally buying certainty of outcomes and mitigating that first 15% drop. However, structural brilliance on paper doesn't always translate perfectly to your retail trading account. We need to shift gears to an objective evaluation in Section 4, costs, efficiency, and friction. Now, what's really interesting when you dig into the numbers is the incredible discrepancy in fees versus scale. Look at ABUF's expense ratio, just 0.30%. That is a massive structural cost advantage compared to legacy peers in the space, which are charging 0.79% or even a staggering 0.95%. But we have to juxtapose that incredibly low fee against ABUF's assets under management, just over $7 million, and its microcap trading volume of just a few thousand shares a day.
Because ABUF is so new and lacks deep institutional liquidity, it introduces trading friction. You see a relatively wide 0.22% median bid-ask spread. Because it's a microcap fund with low volume, trying to move a lot of money in or out can be kind of like trying to squeeze a large crowd through a really narrow doorway. So while the annual management fee is structurally cheap, the actual cost to execute a trade, buying and selling the fund, can be quite a bit more expensive for everyday retail investors due to this spread.
Which leads us right into our final section, and a really important word of caution: assessing the hidden risks. Beyond just trading spreads, if you are going to use a laddered buffered ETF to protect your wealth, you absolutely must understand the structural hazards embedded in the strategy. The most prominent hidden risk here is the erosion of downside buffers. While the laddered approach mitigates some timing risk, it certainly doesn't eliminate market realities. Imagine you buy into ABUF mid-cycle, and the broader market has already dropped by 15% since some of those underlying trenches began. Well, for those specific tranches, your buffer is essentially gone. If the market keeps falling from that point, you are totally exposed to losses on a one-to-one basis for that portion of the portfolio. Let's move to how this all builds up into the ultimate trade-offs of the fund. For one, your upside is always capped, so you are for sure going to lag in roaring bull markets. Furthermore, as older tranches accumulate gains, they actually lose some of their protective effectiveness, which dilutes the strict buffer strategy over time. Combine that with a massive reliance on Aptus's own proprietary funds and that microcap liquidity friction we talked about, and the picture becomes a lot more complex. Ultimately, it comes down to what you are trying to solve for in your portfolio. ABUF presents a fascinating, mechanically sound, and extremely low-fee tool for navigating market turbulence, provided you can handle the liquidity constraints of a young fund. So it leaves us with this final question to chew on. Is that defined 15% downside protection truly worth the sacrifice of capping your upside potential? It's a critical trade-off every risk-averse investor has to weigh.